Fed looks at. I want to bring in Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli. And Chris, I think the big question now is what does the Fed do in that May meeting? And we're looking at Fed funds futures, and they're actually starting to predict that the Fed might take a pause in the month of May because of what we've seen in the banking sector. Your thoughts?
That's exactly right. The Fed has been pretty resolute in raising rates this entire year and all of last year, and ultimately they could take a pause, especially because of what happened within the banking industry just recently. However, it really depends on the data. To your point, at 8:30, they're going to come out with the PCE data. They'll have one more look at the end of next month, and then they have that really important May 2nd to May 3rd meeting where they're going to make their next decision. If inflation continues to be elevated, especially looking at that April 12th report for CPI, in addition to PCE this morning at the end of next month, they're going to have to raise rates another 25 basis points. So the jury's still out. They may need to continue to keep raising rates, but it's really going to depend on the data. That's why it's so important to look at what happens both this morning as well as the CPI middle of April, and then one more PCE reading for the end of next month.
Right. And you know, also too, and this is why we listen to what these members say. You had Boston Fed President Susan Collins say more tightening is needed. She's backing more rate hikes this year. She doesn't see any cuts.
Yeah, that's right. I mean, the Fed funds futures are predicting cuts for later this year. Personally, we don't think that's possible. We can understand where the Fed may want to pause and take stock of what's happened so far, but I think they're going to hold those rates at a high level. So I think the most you can hope for as a stock market bull is that they take a pause and they keep those rates at a high level. I think it'd be very unrealistic for them to cut rates. And if you think about it, whatever would cause them to cut rates this year, despite the fact that they're fighting inflation, would probably be much worse for the stock market than necessarily them continuing to raise rates by 25 basis points. So I think that's a case of be careful what you wish for. I wouldn't be wishing for the Fed to be cutting rates this year, because I think that would indicate something more damaging is going on than even what we saw earlier this month with the banking crisis.
Yeah, I've got another Chris on set with me, Chris Markowski. And you know what? Chris number 2, I'll call you that. Or maybe you're number 1. We can argue about that. But look, I mean, so much for transitory. What happened to that?
Well, that was a joke. I mean, again, anybody can play their own do-it-yourself economist, and you knew just by taking a look at your credit card bill and your grocery bill that it wasn't transitory. And Chris, I would also say as well, you're taking a look at some of the numbers now. If you look at some of the hot real estate markets from not too long ago, you go on Trulia, you start seeing price decreases almost everywhere right now. That's a good sign for inflation waning. In my humble opinion, I kind of like where rates are right now. You know, I'm a financial advisor. I like getting a return on my cash positions. I just think the Fed needs to just stop and just go away for a period of time. Then everybody knows where money is going to be priced. Businesses can make decisions, and we can get back to growth again.
That's a really interesting point. And ultimately, raising rates, all things being equal, are bad for the stock and bond markets. And we saw that last year. But if you maintain them at a reasonable level, and that's open for a lot of debate, but at a higher level of interest, you're absolutely right. You get paid for your cash. Potentially that'll make investors be a little bit more careful about what they back. Look at all the bad investment that was made over the last 13 years. With interest rates held at artificially low levels for long periods of time, that creates its own problem. To your point, we may be at a good level of interest rates right now, given everything that's happening in the economy. And so I agree with you. I think right now is a good opportunity to be in the stock market and the bond markets. It's just a more balanced one. It's the true normal as opposed to the normal that we've been living in under the last 13 years or so.
And you have to be selective, I think, is what you're saying. You have to be very careful about the choices you make as far as your stock and your bonds. Joe Pinion's on set with me.
Chris, just a quick question here, right? Obviously, we know the rates are going up. I mean, I think the thing that we don't necessarily talk about are what are the potential bubbles out there. Certainly, it's not necessarily going to be 2008, but if you look at what people don't talk about as much, that $560 million bond default by Blackstone over in Europe for commercial real estate, you look at the state of commercial real estate here at home. Are there potential looming risks out there, the iceberg that no one sees until the last minute, that could potentially and should be informing people's investment decisions?
Absolutely. I mean, we've seen that in every single crisis. There's always that black swan event, the one that no one anticipates. And that's the interesting part about the risks. If it's something that we're all talking about and that we're aware of, potentially it's not a risk. It's something on people's minds. Just look at what happened within the banking crisis in the last couple of weeks. everyone's expecting a credit crisis, and what we got was a duration crisis in terms of just interest rate asset liability mismatch. So we don't really know what the next bubble is that's going to pop or what the next problem is. Just by definition, it's going to come out of left field. But ultimately, raising interest rates is going to expose those problems.
Yeah.
And so that's why you need to be more selective. That's why you need to be more careful. We're not advocating for our clients to be in cash. That's not a good strategy over the long term. You want to have some cash on hand, but for the most part, you want to be fully invested. And what you want to be fully invested in are good companies with good balance sheets that can make it through a recession, because we are going to go through a recession sooner or later.
Right.
The question is not if, but when. So ultimately, that's what we're more focused on, being more selective, looking at those types of companies that we think will do well in this environment, but more importantly, can make it through a recession, because ultimately we are going to have one.
Chris Zaccarelli. Chris, thank you so much for joining us this morning. It's good to see you.